All right, everyone, on today's episode, risk avoidance and diversification. Welcome to the ultimate crowdsourced personal finance show. This is Choose FI.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, guys, excited to dive into this week's episode talking about risk avoidance and diversification. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. So diversification, I'm intrigued. That's quite a word you've just coined.
Well, I definitely did not coin that, although I don't know if I could give credit to a particular offer. But I mean, the memes write themselves. We'll come back to it. But I would say diversification is diversification gone afoul. We'll come back to that. Let's talk about risk avoidance for a second, because I know it's popped up in your current reading.
Yeah. So I've been reading a book called Richer, Wiser, Happier by an author named William Green. And I would highly recommend everybody in the audience read this book. For me, I read that book kind of concurrently / overlapping with The Psychology of Money by Morgan Housel. And those are two of the best money-related books I've read in a while. But among many quotes that I wrote down, this one stuck out to me. And it was basically in this book, the author, William Green, was more or less interviewing successful value-ish investors, let's say. But I think that's the general sense of the type of investors that he followed, that he considered successful, not only at investing, but at life, right? It's richer, wiser, happier. And a cool quote here by Howard Marks, the co-founder of Oaktree Capital Management. He said, "When taken too far, risk avoidance condemns you to return avoidance." That one just stuck out to me, right? Risk avoidance condemns you to return avoidance. And what I thought of originally, like, this is the concept of opportunity cost, right? Like, what are you giving up? And the initial one that jumped out to me was like, Jonathan, the people who are like, oh, I'm super safe with my money. I put it in my freezer, or I put it in my Globo Bank savings account getting 0.0001% interest, right? Like, but it's safe, right? It's not going anywhere. It's FDIC insured and it's safe. But
there are
the other side of
buts to add on to this. There's so many buts.
I see you chomping at the bit to get in.
No. I would never override you or cut you off just to get my own opinion and slide it in. That would never happen. Return avoidance. It is important for people just to consider there's two different angles. This is a multidimensional problem that you're actually dealing with here. But I think people like, if I can just hold on to my nest egg, hold on to that number, as long as that number's always going to be there for me, then I'm going to feel safe and protected. And the one is, it's the return that you're not getting. It's the return that you're passing up. And I think some individuals, so let's say the market's returning on average 5% a year, 8% a year, 10% a year, 3% a year, whatever that might be. The market generally over time trends up and to the right. And certainly for the last year, it's been unrelenting up and to the right. So there's that return that you've let go on. But I think the one that is more concerning to me, because that person that has $1 million in their bank account and feels so safe and protected right now, the one that's more concerning to me is the lack of appreciation for their loss of purchasing power over time due to avoiding any risk whatsoever.
Yeah, Jonathan, I mean, that is certainly loss of purchasing power, right? Like, that's something we're seeing in real life right now. And I know that's something you've jumped into significantly as far as research goes. And I suspect you're going to want to come back to that later. But for me, like, the way that I look at this return avoidance is in terms of really like the opportunity cost. What am I giving up? Again, there is no question that if you put $100,000 in a savings account at your Globo Bank, that $100,000 is going to be there. this is FDIC insured. Like, we could talk about all the other ancillary things, but that $100,000 is as safe gets, within the realm of reason. But what are you giving up, right? Like, this is what we talk about. The way to get wealthy, truly wealthy, is to invest your money. Now, obviously, there are millions of strategies as far as investing. We don't give financial advice here, but I have long said broad-based, low-cost index funds and ETFs make up the vast majority of my portfolio personally. So this is what I do. And just kind of looking at the math, I think this is really critical. Like, this is such an important concept. And I know it's not great to do math like on a podcast. Obviously, it doesn't.
That's never stopped us before.
No, it's never stopped us before. But, I'm going to try to make this as clear as possible. But it's really important to think in terms of how quickly your money doubles. Okay. So in theory, and this is the beauty of compounding, is that money is building on itself, right? So you have $100,000 and let's say it earns 10%. I'm going to make the public math here real simple for myself. So that first year, in theory, it's going to earn $10,000. And then you've got 110. And then that earns 10%. And that's another 11,000, right? So now you have 121. And then you earn 12,100, right? So it keeps adding. And it doesn't sound like much, but as we've discussed many, many times on the show, the power of compounding is truly remarkable. And I think the easiest way to think about this, again, is like in terms of like, how quickly will my money double? Okay. So there's this kind of loose rule, and this is like, it's rounding, but this is an easy kind of mental framework to think about how quickly will my money double. So Jonathan, you and I say with the number we use is like an 8% return. Okay. Are we guaranteeing if you invest in the stock market, you're going to get an 8% annual return compounded forever? No, of course not. It doesn't work that way. But it seems like on average, based on historical returns, that's a number you and I are comfortable with. So basically, if you're assuming an 8% return annually, there's this thing called the rule of 72. Okay. I don't know where this came from or what, the math just works. You take the number 72 and you divide it just very simply by the return you're expecting. Okay. So if it's 1% in a savings account, it's going to take you 72 years to double. Okay. Not so great. If you get 8%, it's just 72 divided by 8 is 9. Okay. So every 9 years, your money is going to double. That's assuming no additional inputs to that, right? Like you're saving zero. And now, obviously, for people in the financial independence community, we're not saving zero, but still, I set up an example of like how this would work. So I said, okay, somebody started with $100,000. Now, like compare this, right? You're uber safe and you keep it in your Globo Bank, right? That's going to be $100,000 essentially forever. It's going to grow at 0.001, whatever, rounding, it's going to be $100,000 forever. But if you started at 25 with 100K and you put it in an investment that you expect to get about an 8% annual return. Now, remember, that money's going to double every 9 years. Okay. So when you're 34, it'll be 200,000. When you're 43, it'll be 400,000. When you're 52, it'll be 800,000. When you're 61, it'll be 1.6 million. And then when you're 70, it'll be $3.2 million. I mean, Jonathan, comparing $3.2 million versus 100,000, right? Now, this is risk avoidance versus return avoidance. It's the perfect example of that. You are unquestionably, as much as you possibly can, assuming the world doesn't melt down, there's no zombie apocalypse, et cetera. You can't plan for that. So
well, there are plenty of people planning for that.
Well,
Let me tell you what.
Right. They can, yeah.
You're like, I don't even know. Thanks for that softball. I don't even know what to do with it. It's just wide out there.
So, that is clearly risk avoidance. But what are you giving up? What's the opportunity cost? In that case, the opportunity cost is $3.1 million. So you were safe, but you avoided all of the potential returns.
Yes.
Right.
No, don't want that. No, I got what you're doing.
Right. So, yeah, I mean, all of these concepts, literally, as I read this one quote, I'm like, this would be perfect for the podcast because it's so important. And this is something that we all grapple with. There is a push and pull with this kind of stuff. And I'm not saying there's a right answer because, again, as we've discussed ad nauseum, personal finance is personal. And you and I don't push any kind of agenda. We don't say there's only one way to do it. That's not the way the world works. Obviously, you have to figure out what works for you, but let's be clear what you are potentially giving up here. And that is essential to keep in mind.
There's a lot of concepts that we really need to just own and understand and be very comfortable with to really be able to explain our own investing philosophy. And one of those is we want our money to earn money for us. We want our investments to work for us to actually produce income. When you're in the risk avoidance, to the extreme place where it's sitting in, Brad, every time you say Globo Bank, I don't know why, but I think of dodgeball. I think it's like Globo Gym or something like that. Like I'm immediately visual.
I'm not sure. I obviously didn't make up
dodgeball, sponsored by your Globo Bank of choice. It's
I don't want to call out any particular Globo banks, but
yes. All right. So we really want to embrace this concept of allowing or wanting our investments to produce, to do something on our behalf. That's one of these. We also need to kind of understand at some level, depending on what return we're able to get, what sort of total return we're able to get. If it's a compounding return, approximately how long would it take for our money to double? So that really hold on to that rule of 72. You don't need to do, intense math, but like Brad said, you just take that interest rate, whatever you're getting, whatever total return you're getting, and take 72 and divide it by that number. And so if you had a 10% interest rate, your money's doubling every, 7.2 years in that particular case. That's one of them to understand. And think about this in terms of a wealth snowball. And I want to say JD Roth was the first one. It was relatively recently that I heard really coin this and own it and talk about it publicly. But he was trying to contrast very specifically with a debt snowball. Interest, compound interest, total returns, they can work for you and they can work against you. We are trying to aggressively front load our energy, build up some savings, turn those savings into investments, and create a scenario where our investments can form, albeit a humble and small, but growing wealth snowball. And a snowball, as it's going down the hill, it's going to get bigger and it's going to pick up speed, not because you're pushing it, but its own mass and gravity and nature are such that it's going to get larger over time. That's what we're trying to do. And that's why this journey keeps getting easier when you have assets to produce wealth for you, as opposed to just more stuff that you're financing. And it's important to contrast that, because the wealth snowball is the opposite of the debt snowball. And most of us, including many people that have maybe found this show recently, are fighting a debt snowball. When you have a credit card with 18% interest rates that you're paying the minimum payments on, it's working against you. You're pushing uphill and you're trying to take your savings and make forward progress and pay that minimum balance, maybe pay a little bit extra. And in many cases, you're just barely covering the interest charge on your credit card. Whereas when you start talking about kind of, this, I need to clean up my ground game, I need to pay off all the balances on my credit card. The reason for that is we want to get to the other side, right? There's this apex moment where you cross from fighting this uphill battle of debt weighing you down and your extra energy just going to paying off those payments, to now you have the choice. What do you want to put that extra money, that margin that you created for? So what are you going to put it into? And if you say, well, I don't want it, I fear losing $1 more than I personally get joy from making $2. And so as a result of that, because, $1 of loss causes me more agony than $2 of gain, possible gain, I'm going to just park this in a safe place, just my bank account. They're not paying me anything for it, but I know because it's FDIC insured. We could explain that, but it's just something that our federal government rolled out after the banking crisis in the 1920s to keep people from making runs on banks. They said, hey, we want people to be confident in the banking system. I just want you to know, if for some reason something bad happens to your bank, we're going to insure you. I believe, Brad, you can check me on this, up to $150,000 in a single person's account, or if you're married, and it's a joint, or really it's just a joint account. That's the thing. It's a joint account. $250,000 of insurance in a joint account. Brad, did I nail those numbers?
I think it's actually higher now. I am looking this up. Looks like it's $250,000 per depositor. So I guess it's $250 for single, $500 for joint deposits. Is that how?
There it is. So swing and a miss on my part. I was directionally
I think it's
accurate.
Gone up. In fairness, I think it's gone up.
Cool. Well, no one needs to go double check, but if you want to let us know, it's fine. Anyways, all right. So here we go. So okay, you're like $250,000 is what, even if like your bank, you're saying, we're gonna go the other way with this in just a second, but I just want to make sure we're fully fleshing this out for people that are wondering, well, how safe is my bank? If something bad were to happen to your bank, you have as an individual $250,000 of coverage, and as a joint account, $500,000 worth of coverage. And so you're right, it's totally safe, but there's that opportunity cost. There's the opportunity cost of not having that money working for you. And if you were that individual that had a total risk avoidance, $1 million, you and your partner, joint account, $1 million sitting in, a checking or a savings account making less than 1% interest. Well, it's not all protected. 500,000 is protected. If something were to happen with a bank, the other, amount wouldn't. And Brad, you can maybe correct me, and maybe someone else will. You could get around that by maybe having it in different accounts, that sort of thing.
You definitely can. In different banks, people do. People who are, just really want that FDIC insurance, they split banks and such.
So we nailed the safety, but I think it's really, and this is coming back, we're going full circle here. Even if it's 100% safe, there's another hidden cost, a hidden opportunity cost. Even if you decide even at the end of this that you are okay with not making the potential return that you would have gotten in some sort of investment vehicle, and whether we're talking about 10%, 8%, 3%, whatever, you're at 0.01 and you're like, but it's safe. But the question is it? Is it safe? Even if your bank, yes, is totally locked and the government is going to insure it up to some amount and you've got it covered, is it completely safe? Because there's something else that isn't covered there, and it's inflation. It is inflation. And there has been inflation, since we've rolled out our current monetary system, and it varies per year. It's been averaging over the last 40 years. We've had kind of really calm seas, and it's been averaging around 2%. But this year, Brad, this year is probably the first year we've seen anything where it's kind of like, kind of perked your head up and looked around because it's a little different. It's around 5.4%. The CPI, the way they're measuring it currently, was around 5.4%. And it's been trending that way for the last 3 to 4 months. Now, we can't really do anything with that information. We have individuals in our government telling us that it's transitory inflation. It's going to a little bump in the road, might have a year of this, couple years of it, and then it should go back to normal. And we can't comment on that because we just don't have enough information directly. But it is worth pointing out that if 5% inflation were going to be the new standard, that's just what to expect. And we're in this season for 3, 4, 5 years. As different things are kind of leveling off, there is a very real, tangible cost to you and your ability to provide for your family if you're not making any return, but you're 100% safe.
Yeah, I think this is really important for people to understand is that, right, inflation is always with us. As you said, it's been fairly modest, but now it certainly hasn't been modest the last year or so. And we don't know what the future brings. And we had an episode with Big Earn, and we talked about the difference between, transitory inflation and hyperinflation, right? And when it goes over into hyper. And like you said so aptly a minute ago, we just don't know. But what we do as intelligent people is we keep an eye on things, right? And it's important for people to know that what inflation means, your purchasing power is reduced. So $100, or in my example, $100,000, it doesn't buy the same. It buys less, right? Because prices have gone up. And I think, a lot of us kind of see inflation. Actually, the only way that most people normally see inflation is, interestingly enough, through their cost of living adjustment with their salary, right? Like that's why you're getting a cost of living adjustment in essence. It's not surprising that it's usually 2 or 3%. It's essentially to keep up with the purchasing power. So that's really, really important. And Jonathan, I did want to just clarify one thing because I think it's important is that when you were saying the debt snowball working against you, you were not talking about like the debt snowball payoff methodology, right? Like you were talking about what happens when compounding interest works against you, right?
Good point.
So if, we always talk about how compounding interest is this wonderful, wonderful thing that can benefit us, but it works the other way. And that's clearly what you were trying to say. So there's the payoff methods of debt snowball, debt avalanche, the hybrid method, yada, yada, yada. But what you're saying is, okay, when you are paying the minimum on a credit card and it's hitting you at 18, 20, 25% annual interest, man, is that snowballing against you. And it is extraordinarily difficult to dig out unless you are extremely diligent. And I mean, that's really for most people who have gotten to the point where credit card debt is racking up every month. Like it's going to take a sea change. And, hopefully the FI mindset helps with that. Obviously, we've seen that with tens upon tens of thousands of people. But yeah, I really, really wanted to just drill down on that and clarify.
Great points. And you're right. I totally glossed over or took for granted that Debt Snowball is used for different, it has different language purposes and personal finance space. So that's a fantastic point.
Hey, this is Andrew from the Choosify team. Hope you're enjoying the show. We're going to get right back to it after these quick messages.
So Brad, I put together just a kind of a math calculation for us, just so people can appreciate how it, maybe it's an extreme example, maybe it's not, but just so people could just appreciate how important it is that we don't lose our purchasing power. It's kind of hard to visualize because you're not actually, let's use this 5-year example where this individual has $1 million spread over these FDIC insured accounts. They're not going anywhere. They're getting 0.01% interest, so they got a $100 check waiting for them at the end of the year for their business on these various accounts. But, it's effectively a rounding error, but it's not going down. Here's the problem. 5 years from now, it will also not go down, right? They might even have, an extra $500 from the interest over that period of time on that tiny, tiny little bit of interest that they were getting. It hasn't gone down, but they're not able to buy as much. And the way that you would see that is maybe, and I'd actually be curious for you, Brad, especially for individuals that track their groceries very closely, like have your groceries gone up at all over the last year? Would you say that, yeah, we've actually added in an extra $50 to $75 a month for our is there some, that would be the type of numbers that we're interested in. Have our gasoline costs gone up? Have our utilities gone up? Has our rent gone up? If you're paying rent. I know a lot of people have commented that rent appears to have gone up over the last year. These are the types of things that you're talking about. So it's kind of hard. I'm going to try to equate for you what 5% inflation would do in terms of purchasing power. But in reality, it wouldn't be your purchasing power has gone down to be, as Brad pointed out, things just cost more, right? So it's just, there's a little separation here, but this is the best way to indicate it. If you have 5% inflation working against you, for 5 years. So, year 1, 2, 3, 4, 5, at the end of 5 years, your $1 million that you have is still showing up as $1 million in your bank account. But in terms of what it's actually going to be able to purchase for you would be about the same as, $773,000 or $775,000 today. So, you've almost lost $250,000 or almost lost. So it's like between 22 to 25% of your purchasing power over that same period of time. So again, risk avoidance to this extreme is return avoidance, but even worse than that, in an inflationary environment where you don't have anything else going on, it's tangibly costing you your ability to maintain your current level of income, your current purchasing power.
Yeah, and I think that's really important just as a concept, right? So like, as we've said multiple times here, we don't know what's going to happen in the future, right? But that's beside the point. It's that inflation is always happening, right? Regardless of whether it's a fairly modest 2% or a somewhat more catastrophic 5, 6, 7+%, right? Like we have no idea, but regardless, the concept holds. And this is what I really want everybody to walk away from here, is that this is constantly happening. And therefore, this is the return avoidance, risk avoidance issue. So if you are not investing your money, if you think you're being safe, you are not. Because certainly, even at 2% inflation, over the course of decades, this is going to be a remarkable reduction in essence, the value of that money, right? It's just common sense, right? Like you see it when you talk to your grandparents, like, oh, a movie used to cost a nickel, right? Or a quarter, or a gallon of milk was 15 cents. I'm just making stuff up, right? Like you hear these stories, but like that is largely due to inflation, and it's just normal inflation, right? So like, okay, you've seen it just in the course of your single grandparent's life because they tell you stories. You don't conceptualize it like that, but that is the insidious nature of even standard normal inflation, right? So like, again, that's why it's important. It happens. It's obvious. You've heard stories. So therefore, being so risk avoidant by putting your money just essentially under your mattress or in a freezer, it's not helping you, right? Like, it's condemning you to having less purchasing power in the future. So therefore, you need to invest the money. I think that is really the big takeaway here. And obviously, it's not our place to tell you how to invest. But I mean, I think for me personally, how I invest is largely with certainly 80+% of my net worth, it's a broad-based, low-cost index fund. And I think that's something that allows me then to have another, and Jonathan, this is a change that I've had over the course of the years, is another 10, 15% to invest, let's say, in real estate, right, Jonathan? We've talked about that, where when we started this podcast, I was scared to death to invest in real estate, but now I have multiple single family rentals. I've invested in some other crowdfunding type real estate platforms online, et cetera. So like for me, that's the strategy that I've hit on currently. But regardless of whatever that strategy is for you, and again, personal finance is personal, you have to invest the money. You can't let it sit there, plain and simple.
Yeah, and I think that's the key is, we start talking about this idea of diversification versus deworsification, that kind of idea that we used at the beginning. We did a wonderful episode, in my opinion, strongly biased, but a wonderful episode. It was episode 13. We did it with Frank Vasquez. He is the host of Risk Parity Radio, wonderful podcast if you haven't checked it out. But he really helped us to take this idea of diversification and more accurately call it, or identify it as a correlation or negative correlation, which when people are talking about diversification, they're not always really clear on what the goal of that actually is. So my idea of diversification is I don't know what the winners are going to be and the losers. So like JL Collins, I'm just going to own them all. And I'm going to do it I'm going to control the only thing that I can control, which are the fees. I can't control the performance, but I know what the market has done over, a long enough stretch of time, and I can control the fees. And you guys have heard us talk about those, ad nauseum. And then, Brad, you're talking about this kind of percentage ratio. I think it's reasonable for people. How do I structure my investments? So if you're, saying the vast majority of my investments, so 80% are focused on this strategy. And, we were talking with JL Collins for the Simple Path to Wealth, depending on where you are in the accumulation phase. Maybe some people are 100%. Maybe some people take an 80-20 stocks to bonds, or a 70-30, 60-40. There's various levels of, how you're structuring this just in terms of our percentage. Where is it actually going? But I really like looking at it through the lens of diversification, but being very cognizant that I'm not trying to do diversification, right? I'm not trying to own 8 different index funds that have slightly different managers, but all go in the exact same direction. I'm not trying to do something where I think I'm diversified by having this kind of really complex portfolio, but really they're all just going to do the same thing. And I'm just kind of muddling up and making it harder for me to focus on what my goals actually are. So Brad, in your case, you have this, 80% broad strokes, broad market, get the fees ridiculously low. And then with the balance, you're focusing on real estate. You are diversifying into real estate. It's a good diversification tool. It's not 100% correlated with what the market does. It has its own, ups and downs and things it's susceptible to, but it's not 100% correlated. And some people choose things like 10-year treasuries and government funds and bonds and that sort of things. And this is where it gets kind of interesting. Just in the example that we chose right now, if your primary tool was like, and this is actually the preeminent, most popular, safest, investment tool out there. If you want to invest, but you want to be safe, it's a 10-year treasury. But Brad, I think the return on that's like 1%, which is really interesting in light of what we're actually talking about right now. That is, yes, you're investing, and yes, it's extremely safe, but it's still like, even in a 2% world of inflation, it's not keeping up with it. So you are locking in a real loss of 1%, but it's better than the checking account that was, a loss of 2% in that example, right? So that's just an interesting thing to observe. But anyways, you're looking through your options and you're saying, okay, well, real estate, am I interested in, bonds? Am I interested in government funds? Am I interested in commodities or precious metals, whatever these might be? But you're forming a thesis and you need to understand, kind of why are you, am I investing in crypto? What is the thesis? Why do you have that there? What role does it actually serve? That's just kind of the approach. And I think, if you have a scenario where you've got this baseline that's serving this larger goal, broad-based, low-cost index funds, and you have some amount that's partitioned out for diversification, but not deworsification, that's probably going to be a pretty good approach, keeping in mind that none of us can afford to make a 0% return. Well, maybe some of us can. 0% return, if you end up in a scenario where inflation is running at 5% for a, several year, multi-year period of time, it's going to be very expensive.
Yeah. And it's interesting that, we've talked over the years to a number of people, a number of investors, Brian Feraldi sticks out, obviously. And, Jonathan, you and I have really come around. I think maybe we were a little more dogmatic 3 years ago. I won't necessarily speak for you, but I was a little more dogmatic about just straight index funds. And like I said, that still makes up 80% of my net worth. So it's not like I've strayed too far, but people like Brian come in and talk about individual stock investing. And, they talk about a potential like barbell strategy where, you have something with a potentially huge upside on the one end, and then your standard investing. And I'm probably paraphrasing this somewhat wrong, but like, giving yourself the option for potentially huge returns with a small percentage of your investable assets. And, that is appealing to a lot of people, as opposed to just, hey, you have to close your eyes and invest 100% of your available net worth in index funds, right? And like, it just simply is too dogmatic for people, even though I think for the vast majority of people, it probably is still going to outperform or come pretty darn close. So I'm not questioning the actual strategy, but you have to understand psychology. That's one thing we've learned a lot through the years, is that how people mentally approach their money and their investing is really important. And if you tell people, it's almost akin to like a diet, right? Like, hey, it's forbidden to do X. Well, people are going to long for that a little bit more. So like, I think that's why like giving people some latitude and some grace to say like, okay, even people like Brian Feraldi have a significant portion, I don't know the exact percentage, but a very, very significant portion of their net worth in index funds, right? People like Chad Carson and Paula Pam, people who we think of as real estate investors, they still invest significantly in index funds, but yet they have their additional strategies. And I think that's kind of a cool way to approach diversification. And for me, like, again, the deworsification that you're talking about, like, that almost seems like somebody who's like trying to be too cute by half, right? Like, hey, I'm going to invest in every single thing and I'm a genius and I'm going to figure it out. Like, you're really not, in all likelihood. And it's almost always going to end up badly, as opposed to somebody who says, okay, this is like the main baseline of my investing thesis, but you know what? I do want to experiment. And if somebody puts in 1 or 2% of their net worth into even something like you said, crypto, like, I don't blame somebody if they put 1 or 2% in something like that, or real estate, or whatever it is. Like, there's some aspect of this that's intellectually stimulating also, right? Like learning new things. Like sometimes you chalk something up to, okay, even if this goes to zero, it's still better than spending $60,000 a year on college, right? Like I'm learning something. Like, I'm this is kind of an extreme tongue-in-cheek type example, but like, that's not a terrible way to approach something either. So anyway, long story short, I think diversification is important, and also giving yourself that freedom and space to say, all right, there's no dogma. I need to figure out what works for me personally.
That's exactly it, man. And you got to hold both of these at the same time. One is that the market always goes up, and two is the market's going to crash at the same, you got to hold both of those and recognize that both of those are true statements. It doesn't go up all the time, but it's going to go up. And also the market is going to crash. It is going to crash. And you're like, well, what does that mean? Well, you got to experience that. You got a test run of that last March. You got to see what that actually means. The market crashed, and those that had a strategy kept investing through the crash. And I think last year, the market end up making 20% last year? And then this year, I'm looking at it, I'm checking this right now. It looks like it's up like 20%, this year as well. Now, I'm not saying that it's going to finish the year at 20% this year, or that it's going to get 20% next year, but that both of these statements are true. The market always goes up, but not all the time. And the market is going to crash. And when it goes up and you look back and you say, wow, in 2019, we had did we have a 20% year? In 2020, do we have a 20% year? In 2021, do we have a 20% year? Wow, holy crap. Look at my net worth, on the one end. But then two, you're also going to have a monster crash at some point. And a lot of millionaires are made from people that invest through and during the other side of monster crashes. And the part that is so difficult and impossible almost is the monster. It's not necessarily impossible to nail the crash, so some people can get lucky one time, right? Like, let me actually clean this up even more. You need to really appreciate this. Timing the crash, right? Because that's what I just don't want to avoid the crash. So I'll just avoid when it goes up 20% and then I'll get out before the crash. There were people that thought 2012 was going to crash and have been out of the market from 2012 to today. Brad, what would be the returns that they have avoided by being out of the market since 2012?
Yeah, I mean, it has to be multiples, you would think.
Multiples.
This has been the ultimate bull run.
Yeah. Yeah. So it's not enough to get right once, because the very nature that made you pull the trigger early to get out when you thought you were going to get out and have all your chips on the table and your Globo Bank being safe were the ones that wouldn't let you get back in, right? Like there were a few people, and I remember one individual notably that was like, I think something bad is coming. I want to get all my chips off the table going into March. And I remember looking back and saying they nailed it. They got out literally days ahead of the beginning of that ride. But I wonder when they got in, if at any point in time. And if this was done in like a 401k, et cetera, maybe they like dodged a bullet, Brad, that sort of thing. But if this is being done in regular accounts, like the taxes that you incur in many of these scenarios wipe away all your gains. I'm going it's way more complicated than I meant to get. But my point is, when you decide that you are going to time the market, there are a lot of people that would say, I was early, but I wasn't wrong. But if you're early 2012 calling something that happened in 2020, early is indistinguishable from wrong, right? It's indistinguishable. So risk avoidance in your case was return avoidance. You just got to be intellectually honest about that and just call it a spade. And it's not good enough to get it right once. You also got to figure out when to get in. Now, if instead of that, you could say, I don't know when it's going to happen. And if the market's going to go up 30% in 2019, 21% in 2020, and 20% in 2021, that's great. But oh, by the way, if there's a pandemic hits and it drops 30%, I'm going to take advantage of the fact that I'm still in my accumulation phase, and I'm going to, buy the dip, for lack of a better term. I feel like that phrase has been aggressively memed recently, but buy the dip. And you're going to dollar cost average your way in, and you are going to have a better price per average per, share by the fact that you're just getting more shares per dollar when you buy the dip. That's an appropriate way of looking at it. But you got to be very confident on your overarching strategy and understand why you're doing that. We're not investing, the way that we're investing because we think the market always goes up all the time. We just recognize that that's the trend over any historical period of a long enough duration. And we're on the ride. And when it goes down, we have a strategy for that too. If the market went down 90% and you're still earning income, you're still investing through it, wow, you're buying a fire sale. I don't think that would be a fun period of time to live through. It'd probably be very chaotic, but you're buying a fire sale at that point. And J.L. Collins pointed this out to us. I'll give this back to you, Brad. The market and index fund in particular are self-selecting. So as the market, and it's really kind of important to lock this and understand it, as the market is going down, you're owning less and less of a percentage of the ones that are becoming, less valuable. So there is a mechanism where it's actually got your back and it's making sure your money goes, farther, even during a monster dip.
Yeah, I think Jim calls that self-cleansing. That's the way those index funds work. And just to kind of use this final example that we've been weaving throughout this episode here of this person who has $100,000, right? And they just have it in their savings account, earning essentially zero, right? It's ultra safe because they're worried that really, if I could, go into the psyche of this hypothetical person, they're worried that when they invest, if they put it all in, the market's going to plummet 50%. Okay. But let's game that out, right? So they put $100,000 in on day one and the market plummets 50%. Okay. So they're down to 50,000. Now, obviously their psychological state is not wonderful, but assuming they could somehow stay the course, it's still the math of doubling, right, Jonathan? So 9 years later, assuming that 8% annual return, 9 years later, they're back to where they were. They're back to $100,000. So if you're running a horse race, the person who was quote unquote safe, just kept it in the bank, still had 100. Now the person who went through the psychological turmoil started essentially at 50, but 9 years later, they're at 100. Then 18 years later, they're at 200,000, right? 27, they're at 400. The math still works, even when you have this catastrophe. Now, again, would not be fun to live through.
Don't move on too far, Brad. Were you going to add on how it gets even better than that? If especially this was their first decision as part of their ongoing 30-year investment strategy. So if it went down 50% that first year, if they never invested anything again, the numbers you gave were right. But if that was their thing, and then the next month they make their next, purchase, they're buying at a 50% fire sale. They're buying, and to the degree that the market takes a while to start building back up, over time, as it compounds and grows in nature, they're going to far outperform what you just described.
Yeah, you are spot on. And right, again, I've been setting up this kind of weird hypothetical, but in real life, again, we're talking about a 25-year-old in this scenario, but it could be a 35, 45, it doesn't matter. But in this scenario, this is a 25-year-old who has had the wherewithal to save 100,000. To your point, obviously that person, or really any person of any age in the FI community, is going to be saving money every month, right? So again, if we're talking about this ultra return avoidance versus, okay, well, damn, the market went down 50%. It's catastrophic, but the math doesn't lie, as we've talked about multiple times. And like you said, you're getting these same companies for a 50% discount. That's the thing. Stock market investing is not gambling. You're not buying little pieces of paper or digits on a computer. You're buying a tiny, tiny little percentage of, in the case of a total stock market index fund, of over 3,000 companies. 3,000 companies with tens, if not hundreds of millions of workers, right? You are an owner of those companies and you just got it because the market went down for whatever reason, rational or irrational. The market just went down 50%. So you're able to get it at a 50% discount, that same percentage ownership of that company. So that is phenomenal. And when you do that, again, over years and decades, the numbers that I set up of, $3.2 million, multiple doubles down, it's going to be so much higher than that, right? Like, Jonathan, we can obviously run a compound interest calculator, but rest assured, if you're saving a FI type percentage of 20, 30, 50% of your income or more, I mean, goodness, the compounding, it's so much fun to look at. Like, I challenge every single person listening, just Google compound interest calculator and just play around with it. We have one on our site, right, Jonathan, on the resources page of choosify.com, which is fantastic. William created for us. So definitely start there. But there are a bunch of these compound interest calculators, and they are a lot of fun to play with. And you see, like, wow, if I put in $1,000 a month, even if I'm starting from zero, I have how many millions after, 30, 40 years? Like, it's a fun, remarkable thing.
All right, my friends, I hope you got value from kind of this analysis. And there's this continuum, right? Risk avoidance, return avoidance, diversification, deworsification, just coming up with a plan that you feel confident in. And regardless of what happens in the market, you realize, okay, well, this didn't break my plan. This was accounted for in my plan. This sets me up for these steps, whatever that might be. I hope you find that encouraging. And let me just encourage you you.
That was good, John. Wow.
I didn't realize what happened. I'm actually speechless. So we have a newsletter. It's a weekly newsletter. Brad sends it out once a week, and we'd love for you to join us on that and be a part of it. It is absolutely created from scratch each week just to kind of let you know what Brad's reading, what resources we're finding useful right now. And really, most importantly, we ask this: what's the one thing you took action on? And we'd love for you to participate and share your wins with us, what you did take action on. Go to choosify.com/subscribe. It's easy to get on the newsletter. It's a once a week newsletter that you get on Tuesdays. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.